My name is Kevin Price, and I need you to stop whatever you are doing right now. Because what I am about to share with you today is not a trend, not a theory, and not a prediction designed to excite you. It is a pattern that has repeated itself throughout financial history, and right now, in this very moment, it is forming again. And most people are going to miss it, not because the information is hidden, but because they are not paying attention. I have spent years studying the behavior of money, how it moves, where it hides, and where it runs when the world gets uncertain. I have made mistakes with money, serious ones, and those mistakes cost me time that I can never get back. But they also gave me something far more valuable than profit. They gave me clarity. And today, I want to give that clarity to you. This video is about silver. But before you dismiss that, before you think this is just another precious metals pitch, I want you to stay with me, because this is not about silver the metal. This is about silver the signal. It is about what happens when a critically undervalued, industrially essential, and historically monetary asset reaches a breaking point. And right now, silver is sitting at exactly that point. Let me take you back to a period in my own journey. There was a time, not too long ago, when I was watching the markets carefully. I had done what most people do. I had put my savings into the places that felt safe and familiar, the things that everyone around me was doing. Stocks, mutual funds, a little real estate on the side. And for a while, everything felt fine. The numbers were moving. The accounts were growing. I felt like I was doing it right. But then something shifted. Not overnight. It never happens overnight. It happens slowly, the way most financial storms build. Inflation started eating into the real value of everything I had accumulated. The currency in my accounts was technically growing, but what that currency could actually buy was quietly shrinking. And I remember sitting down one evening, looking at everything I had built, and feeling a very unsettling feeling. The feeling that I was running on a treadmill, moving, but not actually going anywhere. That was the moment I started asking different questions. Not where should I put my money to grow, but where should I put my money to protect what I have already built and still allow it to grow in real terms? That question led me down a path that most people never walk. And that path eventually led me to hard assets, to commodities, and over time, to silver. Now, I want to be honest with you. When I first started studying silver seriously, I was skeptical. I have the same thoughts you might be having right now. Is this just for conspiracy theorists? Is this old-fashioned thinking? Is this relevant in a world of digital payments and instant transactions? Those are fair questions, and I am going to answer every single one of them over the course of this video. But first, I need you to understand something fundamental. Something that forms the entire foundation of why silver matters, why it matters right now specifically, and why the window you are currently looking at may be smaller than you think. Every major asset in history has had what I call a moment of recognition. It is the moment when the gap between what something is actually worth and what the market is currently pricing it at becomes so large, so undeniable, that the market is forced to correct. That correction is rarely gentle. It does not happen in small, polite steps. It happens in a surge, a squeeze, a rapid repricing that catches the majority of investors completely off guard. Silver has been building toward one of those moments for a long time. And the evidence for this is not based on speculation. It is based on supply data, industrial demand trends, monetary history, and the behavior of institutional money, all of which we are going to walk through together. But before we get into the numbers and the mechanics, I want to spend time on something that most financial channels skip entirely, and that is the mindset. Because here is the truth. Even if I give you every piece of data, even if I show you every chart and every supply-demand graph, if your mindset around money and investment is not grounded in the right principles, you will still make the wrong decision. You will still panic at the wrong moment. You will still sell when you should be holding. Or worse, you will buy for the wrong reasons and then abandon your position the moment things get uncomfortable. So let us start there. Let us start with how to think about an asset like silver before we talk about whether to buy it, when to buy it, or how much to buy. The first principle I want you to internalize is this. Wealth is not built by chasing what is already popular. Wealth is built by recognizing value before the majority does. This sounds simple, but it is incredibly difficult to practice because it requires you to be comfortable being in a position that feels lonely, being in a position where the people around you do not understand what you are doing, where the financial news is not talking about what you are invested in, where the excitement is happening somewhere else, and you are sitting quietly in your corner, patient, informed, and waiting. Silver, right now, is one of those lonely corners. And that loneliness, that lack of mainstream attention, is precisely what makes it interesting. Think about the assets that created the most wealth for the people who held them through their early stages. They were all, at some point, ignored or undervalued by the mainstream. The people who benefited most were not the ones who jumped in when everyone was talking about them. They were the ones who did their homework early, who understood the fundamental value, who had the discipline to hold when others were indifferent. That is the position silver investors are in today. Not excited, not panicked, just informed, and quietly positioned. The second principle I want you to hold on to as we go through this video is this. You do not invest in an asset because of what it did yesterday. You invest in it because of what its underlying fundamentals are telling you about tomorrow. And when I look at the fundamentals of silver right now, what they are telling me is something that I believe deserves your very serious attention. Silver is not just a precious metal that people store in vaults and look at. It is one of the most industrially consumed commodities on the planet. It is used in solar panels, electric vehicles, medical devices, semiconductors, and defense technology. The world is building more of all of these things every single year. And the supply of silver is not keeping up. Not even close. We are going to get into all of that in detail. But for this first part, I want you to simply sit with the idea that silver is a dual-purpose asset. It is both a store of value with thousands of years of monetary history behind it, and a critical industrial input in the technologies that are defining the next century of human progress. That combination, a monetary asset with explosive industrial demand, is extraordinarily rare. And it is the foundation of the argument for why right now may be one of the last opportunities to buy silver before a very significant repricing event. Now, I also want to address something right at the start of this journey together, and that is the word I used in the title, the word squeeze. Because I think it is important that you understand what that word means in a financial context and why I chose it deliberately. A squeeze, in financial markets, does not mean a gentle upward movement. It does not mean a polite increase in price over time. A squeeze is what happens when demand for an asset suddenly accelerates, or when supply becomes constrained, or both at the same time. And the people who are short the asset, the people who have bet against it or sold it without actually owning it, are forced to buy it back at higher and higher prices just to cover their positions. This creates a feedback loop of buying that can send prices far higher and far faster than most people expect. The silver market has structural characteristics that make it, in my analysis, one of the most likely candidates for exactly this kind of event. And the evidence for this has been building for years. But again, I am not here to hype you up. I am not here to tell you to dump everything into silver tomorrow. That is not wisdom. That is recklessness dressed up as opportunity. What I am here to do is walk you through the thinking, the history, the data, and the mindset that allows you to make an informed, disciplined decision about whether silver belongs in your financial picture, and if so, how. Over the next 5 parts of this video, we are going to cover everything. In this first part, we have established the foundation, the mindset of recognizing value early, the dual nature of silver as a monetary and industrial asset, and the concept of a squeeze and why silver's structural position makes it relevant. In the parts that follow, we will go deeper. We will talk about the historical relationship between silver and gold and what the current ratio between them is telling us. We will look at the supply side of the equation, including mine production, recycling rates, and above-ground stockpiles. We will examine the demand side, including the explosive growth in solar energy and electric vehicles, and what that means for silver consumption over the next decade. We will discuss how to think about position sizing, how much of your portfolio might appropriately be in silver versus other assets. And we will talk about the risks, because there are always risks, and anyone who does not talk about risks is not a mentor. They are a salesman. By the end of this video, my goal is not for you to be excited. My goal is for you to be informed, genuinely, deeply informed, in a way that gives you real confidence to make a real decision. Take a moment, process what we have covered, because the next part is where we start to get into the numbers, the history, and the deeper mechanics of why silver's current price does not reflect its true fundamental value. The history that most investors never read here is a question that most people never ask. If silver has been used as money for over 5,000 years, why does almost nobody treat it as money today? And more importantly, what happens when the market is reminded of that fact all at once? Throughout history, every major civilization that built lasting wealth had one thing in common. They anchored their financial systems to hard assets, to things that could not be printed, duplicated, or conjured out of thin air. Silver was not just decoration. It was the backbone of trade across ancient empires, medieval economies, and early industrial nations. Coins, contracts, reserves. Silver was in all of it. Then something changed. In the 20th century, governments around the world made a deliberate decision. They unhooked their currencies from hard assets entirely, first from gold, then from silver. And with that unhooking came something the world had never experienced at this scale before: the ability to create unlimited amounts of money with nothing backing it. Just trust. Just faith. Just a promise. Now I am not here to tell you the financial system is about to collapse. That kind of language belongs to people who are trying to sell you fear. What I am telling you is something more practical. When currencies are backed by nothing, they lose purchasing power over time. That is not a theory. That is arithmetic. And when currencies lose purchasing power, hard assets that cannot be inflated away become more valuable in relative terms. Silver has absorbed this dynamic throughout history, and it is absorbing it again right now. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged somewhere between 15 to 1 and 30 to 1. Right now, that ratio is sitting far above its historical average. What that tells a student of financial history is straightforward. Either gold is overpriced or silver is underpriced. And given everything we know about industrial demand and supply constraints, the far more logical conclusion is that silver has not yet caught up. That gap between where silver is and where its historical relationship to gold suggests it should be, that gap is the opportunity. And gaps like this do not stay open forever. One more thing I want you to understand about history before we move forward. Every time silver has had a major repricing event, the move has been sharp and it has been fast. The people who were already positioned before the move captured most of the value. The people who waited until it was on the news, until it was in their social media feed, until everyone around them was talking about it, they bought at the top. Not because they were unintelligent, but because they were late. History does not reward the loudest. It rewards the most prepared. The supply crisis nobody is talking about, let me give you a number that stopped me cold the first time I encountered it. The world currently consumes more silver every single year than it produces. That is not a projection. That is not a forecast. That is what the data shows right now, today. And it has been true for several years running. Think about what that means for a moment. In any market, when consumption consistently exceeds production, the gap has to be filled from somewhere. And for silver, that somewhere has been above-ground stockpiles, reserves that were accumulated over decades and are now being drawn down year after year to meet demand that mining simply cannot keep up with. Now here is where it gets serious. Those stockpiles are not infinite, and the rate at which they are being consumed is accelerating, not slowing down. Opening a new silver mine is not like turning on a tap. It takes anywhere from 7 to 15 years from discovery to full production. Permits, environmental assessments, infrastructure, capital investment. The pipeline of new supply is long, slow, and expensive. And the mines that are currently operating are facing their own challenges. Declining ore grades, rising energy costs, and increasingly difficult extraction conditions mean that the cost of getting silver out of the ground is going up even as the price has not fully reflected the underlying scarcity. This is what I mean when I say the supply side of this equation is broken. Not broken in a dramatic, headline-grabbing way. Broken in a quiet, structural way that takes years to become visible and then becomes impossible to ignore all at once. Now layer on top of that the demand picture. Solar panels alone now consume a significant and growing percentage of annual silver production. Every solar panel manufactured requires silver. There is no substitute that performs at the same level at scale. And the world is building solar infrastructure at a pace that was unimaginable even a decade ago. Governments across multiple continents have committed to clean energy transitions that require silver in quantities that the current supply chain is not equipped to deliver. Electric vehicles add another layer. Medical technology adds another. The expansion of 5G infrastructure adds another. Each of these industries is growing. Each of them requires silver, and none of them are slowing down. So what you have is a market where the monetary argument for silver is strong, The historical value argument is strong, and now the industrial demand argument is not just strong, it is urgent. All three of these forces are pointing in the same direction at the same time, and the price has not yet responded in proportion to what the fundamentals are saying. That, in my experience studying markets, is the definition of a coiled spring. Pressure building, quietly, until it cannot anymore. The question is not whether this repricing happens. Based on the supply and demand math, it is difficult to construct a scenario where it does not. The question is only when, and whether you are positioned before or after. How to position yourself without making the classic mistakes. This is the part most financial videos skip. They spend all their time convincing you that an asset is valuable, and then they leave you alone with that conviction and no practical framework for acting on it wisely. And that gap between conviction and execution is exactly where most investors get hurt. So let us talk about how to actually think about silver as a position, not how to get rich from it, how to hold it intelligently. The first and most important rule is this: never let excitement drive your allocation. I have watched people hear a compelling argument about an asset, feel the urgency, feel the fear of missing out, and then put a disproportionate amount of their savings into it all at once. And even when they are right about the asset, the emotional weight of an oversized position makes it nearly impossible to hold through the inevitable volatility that comes before the payoff. They buy high on excitement, they sell low on anxiety, and they walk away convinced the asset failed them, when really their sizing failed them. Silver is a volatile asset. I need you to hear that clearly. It can move 10 or 15% in either direction in a short period of time. If you are not sized appropriately for that volatility, you will not survive the ride long enough to reach the destination. Most serious long-term investors treat precious metals as a portion of a diversified portfolio, not the entirety of it. A meaningful allocation that can move the needle if the thesis plays out, but not so large that it destabilizes everything else you have built. The second mistake I see constantly is confusion about the different ways to hold silver. There are paper silver products, ETFs, and futures contracts that track the price of silver without you ever owning physical metal. There is allocated storage through reputable dealers where you own silver that is physically held on your behalf. And there is direct physical ownership, coins and bars that you hold yourself. Each of these has different risk profiles. Paper silver is easy to buy and sell, but carries counterparty risk. If the institution behind it faces a crisis, your claim on silver may not be as solid as you think. Physical silver that you hold yourself carries no counterparty risk, but comes with storage and security considerations. Allocated storage sits somewhere in between. Understanding these differences before you buy is not optional. It is essential. The third mistake is timing everything on a single entry. If you believe in the fundamental case for silver over a multi-year horizon, then trying to catch the exact bottom is both unnecessary and stressful. A far more disciplined approach is to build your position gradually over time. Buying consistently across different price points reduces the emotional burden and the timing risk simultaneously. You stop trying to be perfectly right and start focusing on being consistently positioned. The fourth mistake, and perhaps the most psychologically damaging, is checking the price every single day. Silver is not a trade. If you are approaching it the way I am describing, it is a long-term holding with a fundamental thesis that plays out over years, not weeks. Daily price checking does not give you better information. It just gives anxiety more opportunity to interfere with your discipline. I want to say something directly here because I think it matters. The people who build lasting wealth from positions like this are almost never the most excited people in the room. They are the calmest. They did their research. They sized their position appropriately. They bought gradually. And then they got out of their own way and let the fundamentals do the work over time. That patience, that structural calmness, is not a personality trait you either have or you do not. It is a skill. It is built by having a clear thesis, a clear plan, and a clear understanding of why you are holding what you are holding. When you know why you own something, temporary price drops do not frighten you. They either confirm your patience or they give you an opportunity to add to your position at a better price. That is the mindset of a long-term investor. And it is the only mindset that works with an asset like silver. The final warning and the decision only you can make. We have covered a lot of ground together. The history, the supply crisis, the industrial demand, the mindset, the mistakes. And now I want to bring it all home with something that I believe is the most important thing I can leave you with today. A warning. Not a warning about silver. A warning about yourself. Here is what I have observed over years of studying investor behavior. The biggest financial mistakes people make are almost never made in ignorance. They are made in full awareness. People hear the right information, they understand the argument, they recognize the opportunity, and then they do nothing. Not because they disagree, but because doing something feels uncomfortable. Because acting on information that the mainstream has not yet validated feels risky. Because waiting for everyone else to agree first feels safer. And by the time everyone agrees, the window is closed. The squeeze I have been describing throughout this video does not announce itself in advance. It does not send you a calendar invitation. It does not wait for you to feel ready. When the supply deficit becomes impossible to ignore, when institutional money decides silver is undervalued, when the industrial demand numbers force the market to reprice, it will happen quickly. And the people sitting on the sideline waiting for more confirmation will be watching from the outside as the move happens without them. I am not telling you to panic buy. I am not telling you to abandon every other financial priority and pour everything into silver. That would be the opposite of everything I have taught in this video. What I am telling you is that the case for silver right now, the confluence of monetary history, supply constraints, industrial demand growth, and historical undervaluation relative to gold, is one of the most compelling fundamental setups I have seen in years of studying this market. The window to position yourself before the broader market recognizes this is still open. But windows like this have a habit of closing faster than people expect. And when this one closes, I do not believe it will reopen at these levels. So here is my final message to you. Do your own research. Do not take my word or anyone else's word as the final truth. Study the supply data yourself. Look at the gold to silver ratio yourself. Examine the industrial demand projections yourself. And then make a decision that is grounded in your own understanding, your own financial situation, and your own long-term goals. But do not let the discomfort of acting early stop you from acting at all. Because in investing, early and uncomfortable almost always looks like genius in hindsight. And late and comfortable almost always looks like a missed opportunity. The information is in front of you. The fundamentals are clear. The historical pattern is established. What happens next depends entirely on what you choose to do with what you now know. I am Kevin Price. I hope this video gave you not just information, but a framework for thinking about your financial future with more clarity, more patience, and more confidence. If this video brought you value today, please take 1 second right now and hit that like button. It costs you nothing, and it helps this message reach the people who need to hear it. If you are new here and you want more long-form, honest, no-hype financial thinking, subscribe to this channel and turn on the bell so you never miss a video. And if you have questions, if something in this video sparked a thought or a concern or something you want to go deeper on, drop it in the comments below. I read them. I respond. And your question might become the topic of the next video. This is not the end of the conversation. It is the beginning of one. And I will see you in the next video.